Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. It's an absolute delight to get in Abhay Agarwal today because I can tell you viewers, in my conversations with him, both public as well as private, his calling on what's happening to the broader macro and growth as well as sectors has turned out to be really, really spot on. And Abhay, kudos on that. I'm guessing your investors would be benefiting from that. But thank you so much for joining us today.
No, thank you, Niraj. Great start to the day whenever I get on the show with you. And thank you so much for the nice words. I really appreciate the fact that, you listen to me and then, you actually track what we have been saying. And so it's really nice to get in a conversation with you always.
That's what we do, and that's why the idea is to tell our viewers what some of the thought processes are in the markets, right? So, Abhay, I'd love to understand from you. One question, when we were having this conversation around valuations, right? I want to start off with that and then get to some specific pockets because I've had conversations with a few managements and I'd love to have your thoughts there. But first, with the misses that were recorded until Diwali, the index was probably trading at about 20 times with the corrective moves. Then there has been a bit of a bounce and stability in the Nifty, but the earnings misses have continued, right? With what with Britannia, what with ONGC, what with some of the others that have come out on the Nifty itself, right? So we're probably trading at 20, 21 times at the very least, baking into account some of the earnings misses, if not all. So my question to you is, if indeed all the misses get accounted for, and therefore at 24,000 levels on the Nifty, if we are trading at 22 times, let's say, and there is a fear of a wobble in Q3 as well, is it prudent to say that upsides on the market are capped for the time being?
Neeraj, I think the broad, to start answering that question, I think what we have to do is look at the broad cyclical downturn that the economy is going through, and that is led by lower than expected demand, consumption demand. So post-COVID, we saw a situation where the economy was firing, the consumers were consuming, and there was easy flow of credit. RBI started tightening credit availability, and I think rightly so earlier this year. And that impacted domestic consumption where people already had, their fill. So it's not that the consumption was still rising. So in that environment, the increase in cost of money and also the increase in cost of consumption itself, you look at the car prices, home prices, everything went up. So we started seeing a cyclical downturn in consumption in the last quarter itself. Pre-Diwali, we saw inventory, getting a lot of inventory with auto dealers, consumer electronic dealers, paint, tiles, polish, woodwork, everything. And I think that cyclical downturn is right now. We're in the middle of it. So probably half of it done, half more to go. So we are not expecting on the earnings side any earning recovery for at least next 2 quarters, because these cyclical downturns are par for the course in a growing economy. So I don't think there's anything to worry that this is a structural downturn or this will not come back. It will come back as inventories become leaner, but it will take 2 quarters more. So in that environment, now looking at your question, Neeraj, that is the market valuation justified? I don't think so, because it is baking in a continuous increase in earnings. And before this earnings season, for the Nifty earnings, the expectation was a 10% earning growth, which was tapered down to 2.5% earlier this month. And now it is negative. So in that environment where earnings are not growing, at least in the foreseeable future, to pay 20 to 22x becomes very questionable. So my answer to your question, Neeraj, would be that I am not expecting any return from the broad market over the next 6 months. It's only when there is clear sight of earning pickup, inventories becoming lean, domestic consumption coming back, cost of capital coming down, capex kicking in, we will see the signs, and at that point of time, I think the valuation multiple would probably creep up. In this environment, I will not be surprised if the Nifty earnings multiple, forward multiple, 1 year forward falls to below 20. And which means, mathematically, I'm not predicting it. I'm not that good a market expert, but for the market to get into the 22,000 range, it's not, unthinkable.
By the way, some flashes on your screen in case viewers missed. That's a large order win for L&T. It's from NTPC, thermal power plants, 15,000 crore order. In a good market, this would have revved up L&T stock and half. 15,000 crore even for L&T is a large order win. That the stock is not moving is just symptomatic of what the market must be feeling right now. Abhay, so there is this BandAid that Indian markets have. It's actually more than a BandAid, maybe a plaster, or maybe a positive shock, as Morgan Stanley called it, of the local flows, right? Everybody is talking about how the October number will be a litmus test. Thus far, that litmus test is turning out to be okay. SIP flows were at record highs too. So therefore that BandAid, that plaster, that positive shock, whatever you call it, that technical factor, if it stays true in this period as well, would that cushion the downside? And therefore, under normal parlance, if you believe that the index could go, I'm not saying you're predicting it, but let's assume that you believe that the index can drift to 20,000, let's say under normal circumstances. With these flows, would that fall be cushioned to something lesser? Let's say 23, let's say 23 half, what have you?
I think, Niraj, we have looked at the SIP flows and the quality of flows to mutual funds from domestic retail funds. And it's very heartening to see that these SIP flows and most of the fund flows that come directly, indirectly into the markets from Indian retail investors, HNI investor, family offices, they are not really trading, they're not looking at Nifty levels to decide whether they want to put money or not. At least a substantial part of these flows are driven for the long term. People have understood that, look, it's a 5-year story. These investments have to be made with a 5, 6, 7-year perspective. And, money has to be made over those cycles, not on a monthly basis. So that is the good part. And I think Morgan Stanley has got it probably right there. So I am not expecting, even with a 10% market correction, I'm not expecting any reversal of these domestic flows, because equity as an asset in India is still highly under-owned. It's still not even 5% of domestic capital, household capital that is invested in Indian equity. So I think there is a long way to go. These are directional moves that will sustain. And I think the Indian household, the Indian investors will benefit from this strategy because, again, as I said, these downturns are cyclical. They're not structural. So they will play out. And when they play out, again, the earnings will pick up and again, the markets will trend up. So I think the flows from domestic retail investors, barring the ones which are trading, but I don't think there is so much of trading there. The SIP flows have been rock solid across all market cycles. So I'm expecting them to continue to come in and provide the cushion that is required. But at the same time, with the caveat that, look, there may not be any immediate gain over the next 6 months on this flow.
Okay. Abhay, okay, let's get one bad news out of the way, and then we'll try and focus on some of the green shoots as well. What has been the biggest disappointment for you in this earnings season? It could be a part of your portfolio, could be just a broad observation, but from amongst the sectors, themes, etc., what has been the biggest disappointment for you?
I think we were not surprised about the disappointment, but I think it was building up in both two cases. One is autos, three segments actually, I would say. So autos is one where we saw inventory levels go up, and mind you, the real impact of inventory buildup in auto numbers will come in the next quarter, because the auto companies recognize revenue when they dispatch to dealers, and then in the current quarter, when the dispatches slow down because dealers are sitting with inventory, the next quarter you will see probably worse numbers from auto companies. So autos have been, a disappointment as we expected. Both the consumer side and the commercial side, and even the two-wheelers, I would say, in that way. Second has been the whole discretionary consumption basket of paints, polish, tiles, again, inventory stacking, a lot of inventory sitting with dealers that still needs to work its way out. Prices under pressure. We will see discounting kick in a big way towards middle or end of December when these inventory levels will become just unsustainable. I think that is when the customers will get fantastic deals, so they should hold their horses. And the third segment is this whole microfinance and unsecured lending space. I think the lenders are really feeling the pressure now, which RBI has been warning, of pushing money into the hands of borrowers who may not need it, but they are just being given this unsecured money because the MFIs and unsecured lenders have to show increase in book size. And that, I think, is going to be very negative for the whole economy, till that cycle reverses and it plays out. So I think these are the three segments where we have seen disappointment, and I think it will continue for at least one more quarter, Niraj.
Okay, okay. So those are the disappointments. There are some bucking the trend, right? Though, Abhay, I mean, for example, if autos are looking very wobbly, but M&M with its SUV portfolio seems to be bucking the trend. So there are some outliers out there. You reckon outliers can do well in an otherwise lowering of the tide?
Yeah, absolutely, Neeraj. I think these are very good companies. They have very good management. So my comment on these companies' cyclical downturn is not at all to say that these are anything wrong with the companies. It's just that they're caught in a wrong cycle, and the management that can foresee that down cycle early on and can reposition its product portfolio, pricing strategy, distributor engagement early on is going to show very good results even in a slowing industry. So I think kudos to the management of M&M that they foresaw this, probably launched products, pricing strategies they adjusted, more supportive of dealers to push out inventory. So there will definitely be these outliers. These companies have great management, so I'm not surprised at all by some of this outperformance.
Okay. What about the green shoots, Abhay? And before I come to consumption by and large, would love their view on banking, because there we've seen some positives, if you will, coupled with the fact that the valuations are not that expensive. Does that place banking in a decent leash, or would you avoid it?
Not yet. I think we are getting close to it, Neeraj. Maybe, slight more time value correction in lenders. When we say banking, I assume that you're talking about lenders, both NBFCs and banks. I think the credit, while they are struggling for deposits and CASA growth, at the same time, the demand for credit is also weakening, as we have seen from the recent data. And it is difficult to call a U-turn on that, that when will credit demand pick up. So I am expecting, even from the leading banks, like a single-digit book growth for next 2 quarters, with a lot of focus on recoveries rather than lending money. What we are seeing empirically also when we engage with some of the bank staff and NBFC staff is that there's a clear direction for senior management to not let the DPD go beyond 90 days. So the direction is very clear: focus on recoveries, make sure money comes in. There is no pressure right now on lending money or building the book. So I think the banks and the entire lending ecosystem is now focused not on growth but on recoveries. So in that situation, I think investors can wait for 3 to 6 months to see better valuation, even if they're time corrected, before we start seeing credit uptake coming in.
Okay, now different facets of consumption have done well. So for example, Abhay, just stay on, because I'd like to get in my colleague Mahima on Jubilant FoodWorks, which is seeing some serious buying today after the results and the con call. Mahima, what stood out in this delivery and the con call?
Right. So I'll start with the key takeaways of the entire Q2 results for Jubilant FoodWorks, where like-for-like growth stood at around 2.8%, which is outpaced most of the QSRs that have come out with the results so far. The dine-in sales were weak at 5.6%, but their monthly active users have gone up by 18.5%, which means that their online sales are really picking up as compared to the in-store sales, and margins were impacted due to waiver of delivery fee. Now their online sales are picking up because of two things. things that first of all, they've promised that their delivery will happen within the period of 15 minutes, and secondly, they've waived off delivery fee beyond a certain cost of per delivery cost, which is why their online sales have picked up. So this is something that has really augured growth for Jubilant FoodWorks in Q2. In terms of the numbers, revenue was up 42%, EBITDA was up 43%, margins were by and large the same as compared to the Q2 FY24, and net profit was up. Net profit was down 31%. Now, net profit was down 31% because of higher staff costs as well as higher depreciation expenses on account of the number of stores that they are adding. In terms of the brokerage views, well, Nuvama has reiterated hold, but they've revised the target price to 631 from 568 rupees earlier. They remain bullish on company's turnaround potential, and the potential like-for-like growth in Q2 FY25 has set it apart in the challenging market that QSRs are facing otherwise. And the focus on delivery and innovative strategies has fueled success for the company, but slight adjustment in the EPS and the earnings estimates they've made. In terms of City on Jubilant FoodWorks, they've retained buy with a target price of 700, and they've cut it slightly from 715, but they say that they continue to operationally outperform Jubilant for them, and recent initiatives to improve dine-in sales and like-for-like growth continues to improve and outpace the sector, and Jubilant FoodWorks still remains their preferred pick in the QSR space. So this is the overall view of how Q2 has panned out for Jubilant FoodWorks, and so it's still started seeing growth in terms of online sales.
Thanks a lot for that, Mahima. Consumption, Abhay, has largely been sulking, but here's Jubilant FoodWorks talking about accelerating growth in Q3. A few others have done this. Is there a chalk and cheese out here in consumption? And define for us, to your mind, what has been chalk and what has been cheese?
And again, as I said, Niraj, that the management, what we just heard from Mahima, that Jubilant FoodWorks took the leadership in waiving off the delivery fees. Now, I think that is the kind of management that can foresee, that they need to do something differently, make some adjustment in the delivery pricing menu to continue to grow in a downward market. So I think the management that gets it is going to do well, even though the costs will go up. They went up, the staff costs went up because they're not recovering for delivery while paying the delivery people. But at the same time, you want to protect your market share even in a down cycle. And so that's when you need to make these bets. I think the market is rewarding the company for that, the stock for that kind of approach that, look, we will not let orders fall, even if it means that we need to give some incentive back to the consumers to consume. So I would like to see more such innovative strategies from different consumer companies across the board, to give an incentive to the customers to consume, not by doing month-end sales or festive sales, but make some tweaks in pricing, make some tweaks in delivery costs to make it attractive for customers to consume. So I think that's where the cheese kind of companies will be. The chalk companies will obviously be who continue to do what they have always done without making any tweaks.
So did you like the commentary from Jubilant, for example? I'm not asking you to comment on the stock as a buy or a sell, but just the commentary.
No, I think the commentary, it's a great brand. I mean, we all are consumers. We all, it's a brand, it's a product that we want to have, so it has its own brand pull, product pull. Now, in that environment, the management has a difficult job of still growing through opening new stores. And it is a point when you hit a kind of, the top, and then you are struggling for where do I open new stores? How do I drive same store sales growth? So they have outlined some strategies. I would like them to see how they play out over the next quarter. But I think the way they are going, they're at least thinking about how to grow both same sales store growth and also add new stores.
Okay. Abhay, the next one is on metals. And I think in one of our conversations, you were saying that in some of the key global materials, there has been a bit of negligence from the investor community. Some of the pricing has come off. Parallelly, there has also been in a relative way, an underwhelming stimulus by China. which some people say they are saving gunpowder for future wars, if you will. My question to you is, what to do in a scenario like this with some of the commodity names? Are you constructive there, or would you stay on the sidelines?
I think commodities is a highly cyclical play. You need to get the cycle right, and then both entry and exit. What we are seeing is that at the global consumption level, China consumes 50% of global commodities and has been largely out of the market post-COVID because of their own internal issues. And those issues relate to a complete falling off of cliff of the real estate market, which was one of the biggest driver of employment, consumption, commodities. Now, with the stimulus, if you see the Chinese stimulus is highly focused first on reviving the real estate market, because without that, they cannot aspire to have an economic growth. On the metal side, we need to get the cycle right, Niraj. And what we are seeing is that with China coming back with the stimulus, we are expecting that commodity cycle pick up. It is because metals haven't done well for a while. Investors have lost hope, and I think bottoms are formed just at that point. When investors are neglecting that big sector that is important for global growth. Now, with all governments, China, US, India, Europe, focused on growth, it is quite natural that the demand for metals will pick up. And in a situation where the supply chains are very lean, inventories are quite lean, and also the manufacturing facilities, a lot of inefficient ones have been shut down, you will see price increase coming in, though not immediately, but over the next 3 months, we expect that prices of metals will start going up. We saw Hindalco results yesterday, which were better than analysts expected, what we expected. So I think you will see these positive surprises from metal companies over the next quarter.
Noted. Okay. Abhay, take a moment to thank you for joining in today and giving us your thoughts. A bit of an incomplete conversation, but we're out of time completely here on this show. But really appreciate your time this morning.
Thank you, Niraj. It's my pleasure to be on the show and talk to you. Thank you so much.